Welcome to Wednesday's Targets in Focus. I'm Elaine Stenson, and today I'm going to be taking a look at currency forecasts for the dollar pairs over the next 12 months. I'm joined on the line now by currency analyst Christopher Vecchio from FX Capital Markets in New York. Christopher, the euro dollar had a terrible week last week, falling around 300 pips. European data disappointed on all fronts, including a rise in unemployment and a drop in German retail sales. The biggest shocker for the euro came from a big drop in inflation at 0.7% year on year, very far from the ECB's 2% target. Together with a not too dovish US FOMC statement. With all of this in mind, what is your 1, 6 and 12-month projections for the euro dollar pair?
All right, so 1, 6, and 12 month. I'm looking for the euro to stay steady over the course of the next month, edging down slightly to 134. This forecast, 134 to 135 really, is tentative on a lot of events actually occurring this week. First of which being the ECB meeting. The second, of course, being NFPs. While I see the potential for a short covering rally in the euro should the ECB not act, ultimately I think that the likelihood of further dovish policy action down the line, coupled with generally resilient U.S. data after the government shutdown. Those ISM figures were pretty strong, and so were the employment sub-indexes. We could have a better than expected NFP, and that could really get U.S. yields moving up, and that would swing favor back in the U.S. dollar's direction. So until we have some substantive policy measures and until we get really anything going on the ECB side, I think that euro dollar is going to stay pretty steady here. Just again, maybe edge lower given where longer-term conditions are pointing. So I have 134 for this time in December. Over the next, say, 3 to 6 month period, I am looking for the euro to pull back down towards 130. Ultimately, I think there too, we're seeing that improving U.S. yields, but as also an improving situation in Europe will steady at least the decline, right? I don't think we're going to see the Eurozone crisis come back as it has, as long as those yields remain low in Italy and Spain. I think that the euro is going to remain relatively insulated to any, longer-term concerns. Of course, if Greece goes under and Italy goes under, you can throw that out the window.
You mentioned Italy there, Christopher, and it has recently been hinted at that Italy may exit the euro. How likely do you think that this is?
I've heard that, but just economically and politically long-term, it doesn't make sense for those larger countries, especially in the case of Italy, considering that they are the world's third largest debt market, and quite frankly, the redenomination of all those assets using the euro and transitioning them back to lira would be exceptionally costly, would cause a huge capital flight, and it would, in the near term, the next 5 or 10 years, it would do more damage than it would help. So at this point in time, because of also the bigger political cost at stake here in Europe, that this was a project formed after World War II with the intent of keeping peace by forming common goals for the future. There is a real built-in desire to keep the union together. So seeing the third largest economy, or third largest debt market leave, the fourth largest economy behind Spain, I suppose, it doesn't make sense. It's too much to lose.
Okay, and the UK PMI surveys are signalling a stronger recovery than was envisioned by the Bank of England earlier in the year, meaning that the projections for economic growth and employment are likely to be revised upwards in its November inflation report. With this in mind, what are your 1, 6 and 12-month projections for the pound-dollar pair?
Right. I think this is going to be a little bit more stable, actually. So over the next month, I'm looking for pound-dollar to trade around 161. 3 months, 158, and 12 months, 155. Obviously, the decline is not as dramatic as what's going on with the euro, and that speaks to the improving situation in the UK. Quite frankly, the BOE has held its monetary policy steady as it promised. The UK economy has improved after their funding for lending scheme in July 2012. We just had the strongest quarter this third quarter in the UK services sector in 16 years. The PMI survey yesterday actually had the strongest PMI reading on record. They don't have any data past 17 years. So what we're seeing here is that the UK really is accelerating, and higher interest rates should keep the pound supported. And we think a big picture, the pound's really declined from its highs in 2007. It was trading up above 2 against the dollar, above 250 against the yen. And so when we consider the ground that the pound has to make up, stronger yields and a less dovish BOE should keep it insulated from any, major swing we see in the relative to the U.S. dollar. I would look for the pound to strengthen more elsewhere, for example, against the Swiss franc or the euro, rather than the U.S. dollar. But again, pound dollar staying relatively stable over the next month to 12 months, I believe.
And finally, let's take a look at an emerging market currency. What are your 1, 6 and 12-month projections for the dollar crossed with the Brazilian real?
Right. So 1, 6, and 12, I have 229, 234, and 246. All right, and this is twofold. One, we've already seen that the implication of a Fed taper is causing significant deterioration in the emerging market currency complex, notably the real, the Turkish lira, the South African rand, a number of the Southeast Asian currencies. So seeing a Fed taper, if the U.S. economy continues to improve and the Fed does move that way, higher U.S. interest rates are going to hurt those currencies. So that's one aspect of it. And so really that, unlike where the euro or the pound, where the Fed taper is really only impacting the dollar component of the trade, the Fed taper for these emerging market currencies, it's really a double shot there because the dollar is affected positively and the Brazilian real is affected negatively in this case. To that end, I think we have a new problem coming into the picture, and which would further support a weaker real. In September, the federal deficit was 3 times larger than what economists had expected. So if we see the talk of perhaps reducing government spending as an effort to prevent an emerging market debt crisis concern from evolving, that too would lead to a weaker Brazilian real, because if the government spends less, then the economy will weaken, inflation will slow, there's less strain on the central bank to fight higher food prices and higher energy costs. Those should pull back as well. So the implication, again, for maybe Brazil now looking to adjust fiscal policy, tightening it there, we could see a weaker currency as, again, those inflation pressures ease over the coming few months.
Christopher, thanks for that, and thank you for joining me on the line today. And that's all from me for now, but Monica Gibson will be back with more currency forecasts on Friday. Bye for now.